Today's Animal Spirits is brought to you by our friends at YCharts. YCharts recently published a blog diving into the debate between value versus growth. They took a look at strategies, insights, and trends dating back to the early 1980s, both stocks and ETFs, to help you decide which equity class is best for your investment goals. Whether you're team value or team growth, you'll get details as to how you can leverage YCharts to create side-by-side reports, build custom scoring models, and illustrate risk versus reward with the scatter plot tool to analyze the performance of either exposure.
One of my favorite charts in here, it's going back to like 1984, and they did the Russell 1000 growth versus the Russell 1000 value, and they have the rolling 5-year total return charts, which is pretty cool. The ability to do a rolling chart like this is cool because you can see when the divergences happen, like in 2000, of course, and then in 2005, growth first, then value. Now back to growth. But the average return for the average 5-year return is almost identical between growth and value. It's a little over 11% since the mid 80s per year. And I'm guessing that if you would have done like a 50-50 growth value and rebalanced, you probably would have done even better.
I like these charts.
No one would actually do that.
I make these by hand. You see the one on the bottom pane? So you've got the rolling 5-year, and then you've got the difference to really like bring it to life.
Yes, you like the spreads. Yes,
this is a really cool spread chart. Guy.
Yes, I probably don't use these rolling annualized returns enough on YCharts.
Am I more of a spread guy or a dump guy? I've been to the dump like 3 days in a row.
Okay.
Just cleaning house. I love it.
All right.
Love it.
Fall cleaning. Good for you. All right. We got a link below if you're on YouTube or in our show notes if you're listening on the podcast. 20% off if you tell YCharts Animal Spirit sent you for your initial subscription sign up.
Welcome to Animal Spirits with Michael and Ben. Happy middle-aged week to Ben. Ben Thursday was your birthday, and you turned 40 what?
42.
How does it feel?
That's probably exactly middle-aged, right? If we're
well, no, maybe literally middle-aged. Although we already decided middle-aged is your 50s.
I didn't know we decided that.
Well, I decided. Okay. No, the internet decided for us. I had something of a middle-aged moment too, actually. I hurt my shoulder, and I don't know how I did it, so I'm just going to assume that I was sleeping.
Okay, this is what happens.
Like a clicking thing.
Wake up sore.
But it's been like 4 weeks. Saturday night, it's 11:30. I've already been asleep for over an hour. I'm in a deep sleep. I might have drank earlier in the day. And all of a sudden, I hear a knocking on my door. And I immediately, credit to me, pop up and run downstairs. I'm like, what the hell? So I get back up, open the door. Nobody's there. Get back upstairs. Ask my wife, I'm like, look on the camera. Who was that? Neighbors. Little
Ding
rascals.
Dong Ditch?
Little rascals playing it. What did you call it?
Ding Dong Ditch.
I call it ring and run. Ring
Okay.
and run. Ding Dong Ditch. Same thing?
Ding Dong Ditch. Yeah, you ring the doorbell or knock on the door and you run away.
Yeah. So like 5 minutes later, they did it again. This time, I run downstairs and out the door in my undies.
You yell at them?
Yeah, I did. Well, I couldn't find them. They scattered like ants. I saw them like hiding behind the bushes. Okay. And I said, knock it off, kids.
Yeah, my Ring camera has got you.
Yeah.
To show your parents. All right. I got no of the middle-aged takes. That's I did write a blog post though about I've been thinking about how much different entertainment options for me and my kids are, because I'm making the case in a blog that streaming services should be pricing higher. Like there's those charts of showing streaming prices going up. They should be way higher. If you think about how we consumed entertainment in the past, you'd walk around Blockbuster Video on a Friday night and there might be 7 copies of a new release movie. And if they're all out, you'd have to go like look through the return bin to see if it was there. They might have 1 copy of an old movie. Like I don't think people realize how great they have it with streaming.
Definitely not. It's the best
you remember
thing ever.
Columbia House for getting CDs? You would pay 1 penny to get like magazine? 10 or 12 CD.
Yeah.
And then they'd send you something every month. And if you didn't send it back to them, then you had to buy the CD.
For like $24.
I would forget it all the time. And I have to buy like the CD the month that I didn't want. I'm just saying, technology has improved so much for entertainment options that people don't realize how good they have it these days.
Over the
weekend. It was way harder in the 90s.
My kids are getting into Ninja Turtles. We haven't seen the new one yet, but I'm very excited to see it. So I showed them the originals, at least as far as the originals to me. The first one was like 1989, I think. The second one was 1991. Fun fact, I had my 6th birthday party at the movie theater. We saw Secret of the Use.
Okay. Was that before or after you saw what movie did you see at 5 years old?
Field of Dreams.
Field of Dreams.
I mean, I'm really.
So your 5th birthday was Field of Dreams. Your 6th birthday was Ninja Turtles.
I'm pretty sure I saw Field of Dreams in the theater. Anyway, I had two thoughts watching that movie. Number one, pizza is the best inflation hedge ever. They got a pie for $13 in 1991.
Wow. It is true. Pizza,
right?
Like if you put the inflation number on pizza,
like, I'm sorry, gold is
a
not
regular
the best
pizza would
inflation
be like
hedge.
$30
pizza.
or $40 right now.
The other thing that I had, the other realization, I said, "Holy moly, is that Sam Rockwell?" Went to the IMDb. Sure enough, Sam Rockwell was like a foot soldier.
Oh, really? I'm a big Sam Rockwell fan. All right, this is the week that.
But anyway, hold on, just to put a bow on this, you're right. You dial up Secret of the Use, $4. It's just everything's right there. Whatever you want.
It's so easy. Yeah,
whatever you want.
I think we take it for granted how hard it was to find. My other thing was in the summer, TV schedules in the summer. The TV channels used to literally say, "No more new shows this summer. Go do something else." It was like September to May was new TVs, and maybe they'd have a pilot or a game show or something in the summer or some repeats. But other than that, there was like no new shows in the summer. It was just kind of like, everyone just decides TV's done for the summer.
Oh yeah, people are complaining right now that there's no good shows on. Oh yeah, there's like 4 million.
Yes, exactly. And literally in the summer, there'd be no new shows. It was crazy.
Although, hand up, I'm one of those people complaining, but shame on me.
Fair.
Forgot how good we have it.
All right, new high in the 10-year Treasury going back to 2007. I found it October 2007, and this has been the story of the last month or so. It seems like we have 6-week cycles now for the economy, right? We go from stagflation to hard landing to soft landing to now, I don't know, growth accelerating. I don't know what we call this. The Wall Street Journal has a story that the era of historically low interest rates could be over. And this is something that me especially, and I guess I could lump you into, probably been the most wrong about over the years, where we thought rates were going to stay low for a long time, or like rates couldn't stay high for this long because something would break or the government couldn't afford it or whatever it is. Hand up, I was certainly wrong on that. But they're saying higher productivity and increased deficits could raise the neutral rate of interest rates, limiting Fed cuts in the future. So they're saying like the potential growth could be higher, swelling government deficits and investments in clean energy could increase demand for savings, pushing the neutral rate higher. Basically, like the neutral rate, I guess, is just what the Fed settles into, which is funny because it seems like there's never like an equilibrium. It's always just moving.
Well, let me ask you a question. Do we think, what about this whole idea that tech was the most powerful deflationary force in the universe? Is that over? Seems a bit premature to make that claim, in my opinion.
I totally agree. I think trying to make any sort of secular call right now, as opposed to cyclical, is really difficult because there really have only been 3 interest rate regimes ever in the modern era. It's flat from the 1920s to the 1950s,
then
up
all the
to
way
the
up,
1980s,
all the way
down since then. Yeah. So it's really hard to make one of those pivot turns, I think, in rates. And if anything, I think things will be more cyclical going forward. But I think it all comes down to government spending. And that if you're trying to hang your head on one thing or another of higher rates and higher inflation going forward or back to lower rates, it really depends on what the governments are going to do around the world and how much they're going to spend. I think that's the tell. And so if you're trying to guess politics, which is probably more impossible than trying to predict the markets. Here's my question for you right now. With rates so high, are bonds more attractive than stocks right now? So this is from the Wall Street Journal, 10-year tips. This is real yields are back to above 2%. I've always been taught that anything above 2 to 3% in tips is like a screaming buy signal. It's like, if you see on here, it hasn't happened very often since.
A screaming buy for what?
For tips, like because you get 2% above plus the inflation kicker, right? So a lot of people wondered, well, what the hell happened? I bought tips because I was worried about inflation, and then tips got crushed. But if you look, tips had negative real yields from 2020 to 2022, basically. Now they have positive real yields.
So the inflation component is part of the pie, but when rates go from 0 to 5, they're bonds.
Yeah, the bond. Yeah, that's the thing people didn't realize is there. But now you have the 2% real yields, which is great. Again, you're actually getting a yield plus the inflation kicker. And if we're just talking regular nominal bonds, rates go up. Obviously, that's not good. That's what people are worried about now is rates continue to go up because the economy is accelerating. But if we have higher for longer, where like rates just kind of stay where they are and maybe in a tight range, that's good. If we have a recession and rates go lower, that's good. I don't know. I'm not like a short-term, intermediate-term guy, but I think if you put them side by side, you'd say bonds probably have the better bet right now, with the
When you say
understanding that
when you say right now, what do you mean? Bonds are more attractive than they were 3 years ago. Do you mean right now
I mean,
for the next
on a
12? Do you mean
relative basis,
right now for the next 12 months? Like, what's your time frame?
I guess my time frame, it depends on what happens to rates, I suppose. But I think if we're looking at stocks and bonds right now, you could make the case that bonds are relatively more attractive than stocks, which is not something I would have imagined myself saying.
Relatively more. Okay. I think bonds are
Like,
relatively.
if we're going to play out the different scenarios, there's probably way worse scenarios for stocks than there are for bonds.
Yeah, I mean, bonds have a much bigger margin of safety with rates at 5% than they did when they were at 0%.
But I still think people are looking at the losses and going, no way I'm putting money into bonds. So
No. You keep saying this, but it's not true. There's money has been flowing into bonds for like 35 consecutive weeks.
Then why are rates rising still? If money's flowing into bonds, why are rates rising?
Because dude, the supply of bonds is not capped. The Treasury is issuing new bonds all the time, and so are corporations.
But if there was high enough demand for bonds, rates would be falling, not rising.
It's not enough. It's not enough to like control.
You're talking about mutual funds and stuff where the bond market is enormous, and if there's government selling, the mutual fund ETF money is a drop in the bucket.
Buying pressure is not enough to drive rates.
Well, it is if it's the Fed doing it, I guess.
Right.
But so I tweeted this out last week. So the long-term Treasury, TLT, 20-plus year U.S. Treasury bond ETF, is down 2.4% over the last 9 years. So we're closing in on a lost decade. And a lot of people tried to actually me and say, no, you must be looking at price return. There's no way that's possible. And if you look on my chart here, it says total return. This is income included. And if you can see, it was close to up to, I don't know, halfway through this period, 2/3 of the way through is up like 60 or 70% from that blow off top and yields falling. Now we're closing in on a lost decade in long-term treasuries, which is kind of nuts considering how great things were coming into 2020 with these.
Yeah.
So Bespoke had one too. Since February 19th of 2020, which was the peak of the market right before COVID hit, TLT has posted a return of negative 32%. ARC has down 31%, which is again kind of crazy for how well these things did during the COVID bump. One of the things that I heard from a lot of people that I've been writing about bonds lately and talking about them is, listen, I don't care about bond losses. I'll just hold my bonds until maturity. That's my hedge. I can just hold till maturity. I don't need to worry about these losses. You see the 7 to 10 year Treasury is still down 21% or so, to which I say that's a great psychological trick, but it doesn't mean that you're not losing out in some way. Like the hold bonds to maturity, people think they have this like secret way to make money in bonds and not lose money.
That's a good point. People value principal protection a lot because you're right. If you're buying an individual bond and you hold to maturity, you will get your money back. But what if you bought that bond at 2.5% and it was a 10-year bond? So you hold that bond for 10 years. Congratulations. You get 2.5%, you get your money back. Rates go up to 5%. What, are you still holding that bond because you get your money back? What about what about the opportunity cost of not getting higher yields?
So this is
you're 100% right.
Cliff Asness had this thing, it must have been 10 years ago, like his big top 10 investing pet peeves. And he talked about the whole hold to maturity, individual bonds versus bond funds things. And he said, I always go back to this. He said, bond funds are just portfolios of bonds marked to market every day. How can they be worse than the sum of what they own? The option to hold to maturity and get your money back is apparently greatly valued by many, but is in reality valueless. The day interest rates go up, the individual bonds fall in value just like the bond fund. By holding the bonds to maturity, you will indeed get your principal back, but in an environment with higher rates and inflation, those same nominal dollars will be worth less. The excitement about getting your nominal dollars back eludes me.
Not me.
Yes.
I totally get it. And I get where Cliff is coming from. But this is how people behave. This is the thing. This is the whole kit and caboodle.
Yes, it's funny to me that some people think like I've got it all figured out. Like I'm smarter than the bond market, but this is not the way things work. If you just sold your bonds at a loss or your bond fund at a loss and put it into shorter term bonds at higher, whatever.
It's a psychological safety blanket. I completely agree.
Yes.
So there's a chart from Bloomberg. We said like there's like hedge funds are short treasuries, asset managers are long treasuries. So there's a chart showing asset managers' net long positioning 10-year treasury futures is at the highest level that it's been since 2006. It says investors are positioned for yields to fall. I don't agree with that sentiment. I think it's rational to take advantage of and lock in higher rates for a longer period of time. So just because you buy a 10-year bond at 4.4% or wherever the yields are, it doesn't mean that you think that they're going to go down to 4% tomorrow, right? It means that, no. I'll take 4.4% for the next 10 years. And if
Yeah,
rates go to,
I'm locking it in.
yeah, I'm locking it in. So if rates go to 4.7%, well, yeah, I'd rather they not, but that's okay. I'm locking in today's rates. It doesn't mean that it's a market timing call.
And again, it's the highest rates we've had in over 15 years.
So I think that totally makes sense.
Here's my funny thing about the finance world, and I know why this happens, but the 10-year yields are the highest since 2007, meaning people finally have some yield they can earn. Wage growth is up, GDP growth is accelerating, and Wall Street absolutely hates it, right? Like everyone is bearish now but my whole contention is
wait, hold on. Like, unpack that. What do you mean Wall Street hates what? And when you say Wall Street, what do you mean? What do you mean Wall Street? Do you mean strategists? Do you mean the bank?
Don't you think rates rising has turned everyone bearish in the last month? But my whole contention is, wait, rates are finally rising for the right reason. Like rates didn't get this high during the inflationary spike and on some of these bonds and the whole Fed tightening thing. Like inflation has fallen, rates are rising because growth is rising. Isn't that a good thing?
Yes. So on the one hand, I think that when you say are bonds relatively more attractive, they're definitely more attractive to themselves than they were. That's for damn sure. But I do also believe that this should cause a repricing of multiples for stocks. I just do believe that. I'm not saying it happens overnight, but if stocks were trading at 20 times earnings with a 10-year yield at 1%, I don't think they should trade at 20 times earnings with a 10-year yield at 5% or 4.4%. Sorry, I just don't. Now, I don't know where the right number is, but I also simultaneously have a hard time getting too bearish on stocks because the economy is too good.
Yes. And it's also that's the funny part too, is your point about re-rating and valuations totally makes sense in theory, but then why is the NASDAQ up 35% this year? That's the part that...
And Nvidia's at an all-time high right now. So yeah, dude, this shit's hard. Like we're trying to like make sense of it all and it's just hard.
And if you look at this is through Monday, the correction, I mean, I think these things just happen faster where stocks are going up. Everyone's bullish and stocks are going down. Everyone's bearish.
This was as they say, a garden variety correction. I mean,
the S&P 500 is down 4 or 5%. The NASDAQ is down 5 or 6%.
The VIX never got over 20. This was nothing.
I mean, whatever stocks if rates keep going up, maybe stocks do continue to roll over. But it's not like this is like a terrible thing. This is you probably average a 2 or 5% corrections a year in most years. It's not like this is the end of the world. But I feel like the sentiment shifts so much faster these days.
Yep.
Even like what it was like 10,
it's social
15
media.
years
it's
ago.
social media. Get used to it. It's permanent.
And maybe that's the point, is that's where I'm getting my sentiment gauge from.
Dude, the crowd, when there's a 5% pullback, the crowd will never say no reason to panic. You know what I mean? Because the loudest voices rise to the top, and that's just what it is.
But but the same thing when stocks are rising too. It's kind of like 2 months ago, it felt like this is a Teflon market. Nothing can stop it. And I guess it's always that way, but it feels more now. I know you and Josh talked about Michael Burry last week on What Are Your Thoughts? Adam Koo had this prediction chart, which I think we can appreciate. You especially like to do the annotations on a chart. I like it too. Just some of his I forgot about the bubble in index funds and ETFs in September 2019, which I actually wrote a big piece about, saying that that's overblown, and I will always kind of say that. My whole point here, Spencer Jacob at Jacob or Jacob? Spencer Jacob?
Yeah. Did
I do that wrong? Okay, sorry. Well, that's like spelling Jeff. GEOFF, right?
Yeah. It's got. What is that? What is a GEO?
We're gonna get hate mail now from Jeff. His whole point of this calling corrections, he says every market crash or bottom has a Babson. Remember, Roger Babson was the guy who called the 1929 crash. Someone who can dine out forever on nailing it. In 1907, it was Elaine Garzarelli who predicted a collapse days before the Black Monday. She became the best paid strategist on Wall Street for a while and went on to run some poorly performing mutual funds. In 1982, it was Elliott wave theorist Robert Prechter predicting a roaring bull market after stocks spent 16 years in the doldrums. That Elliott wave stuff's still around, isn't it? But the crash, as he called, never materialized. And it said, I love this part. In response to emailed questions, Garzarelli says her claims on her website of 94.5% correct calls have been audited. And while Prechter was more humble, admitting criticisms of his record are about right.
Good for him.
Which is kind of funny. At least he's admitting it. My whole thing is, remember the Buffett punch card of like, you should have a punch card and 20 times in your career you punch it and you make a change. There should be like a punch card of like 5 big predictions, like crash predictions. And after your punch card is done, you can't publicly make them anymore. I'm a fan of having the public track records out there for people who make this kind of stuff. That's what I'm saying. And I think that's a good part about the internet, even though some people fail to do their own research on this of the boy who cried wolf kind of thing.
Yeah.
I don't know.
Ben, do you remember when like weed stocks hit the scene? I think it was
what
like
was the Tilray was the one?
15.
Was that the big one?
TLRY, I think so.
Is it almost the case that weed being legal was bad for pot stocks? Is that possible?
Yeah, it's too much supply. Oh my God. I'm looking at like Toke, for example. This is a Cambria fund. And Meb actually has this good thing where it's like, if an asset class is down, I don't know if weed is an asset class, but you get the point. Maybe sector, whatever it was. He had this great study. If something's down 5 years in a row, it almost doesn't matter what it is. You just buy. You know? Like,
oh my gosh. How is this even possible? It's
so
down.
So Toke is down what? It's down what?
Oh no, sorry. I'm looking at Tilray is down every single year since 2018. It was up 292% in 2017 and 310% in 2016. And it's fallen every single year since then, including this year. Oh no, it was up in 2020. Sorry.
I remember when these stocks came out, and I had like I had one family member who was like not bugging me, but you know, really curious about which one he should buy. And I was like, I think I said like, listen, I don't know if these would be great business. I told him about like the airline thing from Buffett. I don't know if that fell on deaf ears, but I don't know that there's be any winners here. It's great for the consumer, I guess. Not I guess. It's great for the consumer, but in terms of investing. Anyway, Jeffrey Patak tweeted, it's not every day you see a strategy go almost all the way to zero in less than 2 years. But this cannabis ETF, which is slated for liquidation, has nearly done it. It's down 90% since its October 21 inception. Leverage and weed stocks, bad combo.
So it's a leveraged weed stock play.
Anyway, Toke, I mean, yeah, it's still basically in the basement. I don't know, stop going down.
I don't know. I mean, you'd think weed investors would have a little more patience because they're a little more slow to react to things. Right? Sorry.
So anyway,
too easy.
Okay, just getting back to the flows for bonds from Daily Chart Book. U.S. bonds attracted $1.7 billion in the week ending August 16th for the 33rd straight week of inflows. So people are buying stocks. I mean, people are buying bonds, excuse me. And then next one, again from Daily Chart Book, mutual money market funds have dominated year-to-date flows across asset classes. This is wild. It's money market funds, all bonds, U.S. government, and then everything else rounds to zero when looking against that scale, because money market funds have brought in $1 trillion. Now, money market funds obviously can't move markets because that's set by the Fed. But even bond buying is not going to. The bond market is so gigantic; it can't possibly influence interest rates.
What's the financial stock play here besides like a Charles Schwab that would benefit from this? Because those money market funds make pretty decent fees. Like those are higher fees than like an ETF. Someone has to be benefiting from this. Is it just every broker is benefiting from this in some way? Plus, they're earning a great spread. They're all charging like 8% on their margin right now, even though they're paying 5%.
What do we say? Markets. What do we say Robinhood was getting? So this whole thing that, and I think we've done this bit, so forgive me if I'm repeating myself. This whole thing about bonds won't lend. I mean, banks won't lend when the curve is flat or inverted because they borrow short and then long. Not really true. Sorry.
They're earning a great spread right now. It just depends on the demand for loans.
Look at your checking and savings accounts. They're not borrowing. I mean, yes, they're borrowing short, but not at rates set by the government. They're still paying zero effectively, or close to it.
Isn't it also crazy how like this is like the immaculate handoff for baby boomers? Like they had this wonderful. I mean, retirees have been complaining for years about the fact that they have no safe yield anywhere, but the stock market went up a ton, housing prices went up a ton, and now all of a sudden it's like all these baby boomers are retiring. And it's like here. On a silver platter, here's this 5% yield for your safe assets. Have at it. I don't think the baby boomers, you couldn't have drawn up a better situation or scenario for the baby boomers from like 1980 to today in terms of how financial markets worked out for them. It's, I mean, low starting yields, high starting rates, 20-year bull market. Sure, there was a lost decade in there, but then a 15-year bull market and now really high rates. Like, you couldn't have scripted it any better for them.
See, I really wanted to interrupt there, but as a co-host, I had to let you cook.
Thank you.
You're welcome. So I'm actually working on a post about this right now. If you are an investor, or if you're a lender, right, / investor, these high rates are the best thing since sliced bread. If you're a borrower, this is the worst thing ever. So Ben, is the Fed worsening inequality by raising interest rates. But wait a minute. I thought the Fed was worsening inequality when they were lowering interest rates. So which is it?
It's both ways, I guess. But
So interest rates are bad for inequality, whether they're higher or lower, they're just bad. And I'm being facetious, but is there some truth in that? That you can make the argument. Certainly, the argument was made the entire time that when rates were low, that the Fed was widening the income inequality gap or the wealth inequality gap. And all kidding aside, with rates high now, is not the same thing playing out? If you already have assets, you're already locked in a mortgage, you have money to invest. This is a huge windfall for you. But if you are borrowing or you are accumulating or you have credit card debt, you're getting destroyed.
There's going to be a line in the sand in like 2021 or 2022 in the future. They're going to look back and go, what happened? It's like housing market, especially. Like
speaking of that, I was playing around with Rocket Money yesterday, and I saw I've got many bones to pick with my recurring charges. Bones to pick all over the place. A graveyard of bones.
With how they're being categorized or what?
No. Like, hand up, this is on me. Somehow I have 3 Sirius subscriptions. I'm going to call them this afternoon to find out what's going on. The New York Times is charging me twice. It's charging my business account and my credit card, my personal credit card. I can't figure out why. I have no idea why. Anyway, I saw an interest charge from American Express. And credit card interest is like 20 something %.
Right.
I'm like, wait, what the heck is this? I'm an auto pay guy, right? But my new-ish card, which I linked to my old account, my existing account, I guess I forgot to set up the auto pay. So I just assumed, right? Shame on me. I just assumed that it was set up. But I never got a notice that I never got an email saying that I had a late charge. Isn't that weird? So I had a late fee for $30 that I called American Express.
They
reversed it. But the interest expense, like we can't do that's corporate or whatever. $106.
Oof.
And that was I'm probably like, I don't know, 10 days delinquent.
Can you imagine the people that carry balances over every month and are looking at those charges? Maybe they just don't look, but I can't even imagine allowing those to build and compound.
It's backbreaking. Ben, what's your number one rule in personal finance?
Pay off your credit card debt.
Boom.
Always, every month. Just live off the rewards. All right. The GDP now has estimates for real GDP at Q3 at 5.8%. This is crazy to me. It's the fastest non-pandemic quarter in 20 years. Like, so you had the big snapback of the pandemic, but take that out of the equation, and it's 20 years would be the fastest quarterly growth that we've had, which is, it really is amazing. I don't know anyone who in their right mind predicted this. It's impossible.
So I think that's why the narrative is shifting. It's like, holy cow, the economy really is accelerating. So they're not going to cut rates. Rates are going to stay higher for longer. And okay, you reprice risk assets. Makes sense.
Conor Sen had this. All of these are reasonable takes. Inflation is still too high. Fast growth is compatible with cooling inflation due to supply chain improvement. Growth is still too fast to be consistent with 2% inflation. Over time, the economy can't handle 5% Fed funds rate. This all makes sense to me. Like there's so many different.
The last one to me is the most salient point. There's no way. So remember we said like so much of the debt is already fixed, right? Your mortgages, whatever. I know this is like fantasy world, but imagine you repriced everything at 5%. Imagine everything, right. You just wiped the slate clean and just said, replace your existing debt with current rates. Sunk.
And maybe this is the reason that everyone on Wall Street is so worried, is because the thinking is, if the economy continues to accelerate, the Fed is going to have to accelerate again. And that is when eventually it's going to break. Like, okay, it hasn't broken yet. We had all these extenuating circumstances. Things have been fine. People locked in low debt. Eventually something's going to have to slow. And I think that's obviously the worry.
Duncan saying I need a financial advisor. I don't think financial advisors are responsible for irresponsible subscriptions. That should be, well, yeah, I told you got to negotiate with them. But I think, you know how you have automatic 401k target date contributions and these things, and like you have a default choice for credit cards. Your default should be automatically paid off every month. And if you want to take that off, you have to go ahead and turn it off. How's that? That's such a great point. You know, that's like auto enrollment for 401ks.
Yeah, that's what I mean. Yeah, it should.
How much money?
You have to opt out, not opt in.
How much money do credit card companies make because people don't get automatically opted in? That will never change.
My sister, her very first credit card out of college, she didn't really know how credit cards worked. And so my dad looked at her bill after like 12 months and was like, Sarah, what are you doing? And she's like, what do you mean? He's like, why aren't you paying off your credit card every month? And she's like, I don't need to. It's a credit card. You can just kind of let it go. And she had no idea interest was accumulating. And she had the money to pay it off.
I bet
just didn't.
A lot of people probably don't know about credit card interest.
That's on me for being a finance brother, not teaching her the ways.
Hand up. This is a great chart from Bank of America. U.S. consumers are still super healthy. Consumer debt as a percentage of GDP is at 2001 levels. Wild. So even with all these rate hikes, it doesn't matter because people already locked it in. You locked it in. It doesn't matter. You don't feel it.
Doesn't this go to our point of, okay, the Fed takes rates to 6 or 6.5% if they have to really like snuff this thing out, and we have some sort of slowdown. I still fall in the like, even if it happens, it's gonna be pretty mild.
So a recession would happen, but it would be mild.
I think that would have to be your baseline, with the caveat that things can always get worse. But that would have to be the baseline. Things aren't like, people aren't just over leveraged to the hilt this time around.
To the hilt,
right? Is that a thing?
Is it to the hills? You might be right. I'm not sure. To the hilt. It didn't sound terribly wrong. But to the hilt. All right. To the hilt. I'm gonna fact check you. To the hilt.
To the hilt is a thing. To the hilt as much as possible. See, we're mortgaged to the hilt.
To the utmost degree. Okay, Ben, not only were you right, but you were exactly right. Credit to you.
I could hear people saying to the hills and with confidence and thinking they're doing it right, but they're not.
So you think to the hills is one of those things people say, but they don't know that it's actually to the hilt?
Right.
The more you know.
What do you got here?
I still get a grain of sand and salt confused. But now I know it's sand.
No. All right.
Wait, is it salt?
Yes, it's salt. We've done this before.
Oh, God. I really thought it was sand.
All right. Yeah.
Are you sure?
Take it with a grain of salt.
Okay. Guess that one hasn't sunk in yet.
Yeah, your confidence level is pretty high there. What's the travel spending thing here?
Oh, I was about to say, Ben, this is on you. Nope, this is on me. My bad. All right. I don't know how to square the circle, Ben. Worldwide spending on business travel will top pre-pandemic levels next year and expand to more than 1.78 trillion according to the global in 2027, according to the Global Business Travel Association's annual outlook. How and when business passenger volumes will recover to 2019 levels remains to be seen. According to travel by large corporations remains stuck at about 75 to 85% of 2019 volume for U.S. carriers.
That's way higher than I would have thought.
But
I would have thought with remote work it would be like 60% of pre-pandemic levels.
But it says spending rose 47% last year to 1.03 trillion and is forecast to increase 32% in 2023.
How much of that is inflation?
Okay. Yeah, but even still,
looking at the box office rates, like this is the highest grossing thing ever, but you don't adjust it for inflation.
But I just assumed, I don't know, that business travel was like dead forever. What would you have guessed it's down since 2019? 50%?
I would have said at least like.
Why? Who's traveling for business?
Yeah, that's a well.
I guess
I've been traveling more, but
that's true. What idiots are traveling?
Yeah. How much of it do you think is people like getting an excuse to get out and travel because they want to get out and travel again? And it's like they don't need to, but they want to. There's got to be a lot of people who that like fall like I got to go to visit the manufacturing plant over here and just get out of the house. The Wall Street Journal had a piece called "Banks Don't Love Rich Mortgage Borrowers as Much as They Used to," saying like they're not getting deals to jumbo loans anymore. But this is interesting to me. So they look at interest on a new car loan by credit score, and they go deep subprime, which I did not know was a thing. Deep subprime sounds like a movie from the 90s. Does it not? Brendan Fraser probably would have been in it.
Deep subprime is much nicer than very poor.
Subprime, near prime, prime, and super prime. And look at the range of, and they're showing that actually the super prime have risen faster than the deep and subprime. But look at how much higher these rates were for having a bad credit score. This is so we're talking almost 15% for deep subprime versus 5% for super prime. Like, you know how they do the FICO score, right? I think it's, so I looked this up. 1/3 is like your payment history. So you got docked already because you forgot to make a payment. So your credit score is going to go down. The amount owed is another one.
Wait, is that for real?
Look at it. Person's payment history.
One late payment?
No, it's not good. It would have to be a series of them. Amount owed is 1/3. Length of credit history is like 15%. So get those credit cards right away and pay them off. New accounts opened is 10%, and then types of credit used is 10%. That's how they determine your FICO score. So having a good credit score. Remember you got me the T-shirt? What did it say? Like, not to brag, I have a great credit score or something.
I did.
You bought me a T-shirt. You had me like a printed T-shirt made.
I feel like I've never seen it. You ever wear it?
A few years ago. Well, you got me like an XL. So I think I use it as a towel. Which someone pointed out, large is in the middle, right? You didn't want to be a large because you thought you were on the upper end.
Oh yeah. Somebody had a great take. They emailed us and said, Michael, small, medium, large, extra large, extra large. Large is smack dab in the middle. Don't discount the number of XXL people out there.
It's true.
But I still say large is average, which I guess that's the point he's making. Here's
an anecdote about how rates are finally starting to have an impact. Christine Johnson, a marketing manager in Chicago, has been looking with her family of 4 for a house in the backyard. They wanted to put down 20% on $1 million home and take out a jumbo loan, but they could get a rate lower if they put 30% down and got a conforming mortgage. And that would be like more of a government-backed loan. So they're considering putting the extra cash down. And she says, depending on where the interest rates are, will dictate what we are doing. Like it's certainly changing behaviors for people, and that sort of thing, like paying down a loan faster or trying to buy down a higher, like that's the kind of thing that eventually feeds into consumption, even if it's on the edges these days. Slowly but surely, that seeps its way into the economy, right?
Duncan coming in with the knowledge drop on late payments. A late payment can drop your credit score by as much as 180 points. However, lenders typically report late payments to the credit bureau once you're 30 days past due. So I think I'm in the clear.
So you're not delinquent yet.
Not delinquent. I'm just
bald.
Showing
up the next Fed's court.
This blew my face. So getting back to like the car stuff, car dealership guy, reminder that some people are paying mortgages for fancy cars. These are real active car leases in 5 states. So an Acura NSX, beautiful car. Not quite a Honda Accord, but still nice. A 36-month lease, $5,600 a month.
Wait, for an Acura?
An NSX.
What's that?
It's their sports car. It used to be like really nice. It was around in like the 90s and they discontinued it and brought it back. Very sweet looking ride.
I'm not a car guy at all. Who's bragging about an Acura? That's all I'm saying.
It's very nice. If
you're gonna do it, get a Ferrari or something. Don't get an Acura. That's all I'm saying.
A Mercedes G63 AMG, $5,100. A Porsche 911, $5,100. A Range Rover, $4,400. Oh my God.
I know that these are really rich people, but would you rather have a Porsche 911 or a vacation home on the ocean or something? This is like the difference here.
It's unbelievable. It's so much money. I'm going to assume that these people, I'm going to assume they can afford it. You're not just like casually getting a $5,000 car. And honestly, what if you have that much money, you know, what's the difference? But that being said, it's just a staggering amount of money. So congrats to the rich people. That's awesome. I had a thought that's like, I don't really believe, but I just wanted to talk it out loud. My train ticket was, well, let's say I don't do monthlies anymore. Let's see how much a monthly is. I think my monthly train ticket used to be like $250. When car prices started to go crazy, I think people were able to rationalize, at least Long Island commuters or New York commuters. Wait, I'm not paying $300 for my train ticket anymore. So if I'm paying an extra $150 for my car, it's still, you know, I'm still in the black.
I could see that. So if people are working from home, they probably also need an automobile more too.
Yeah. So I think that was easy to rationalize.
Yeah. It is surprising to me if you look at the used car prices are coming down, but they're still way, way elevated above 2019 levels.
Another tweet from car dealership guy. Severe delinquency for auto loans is the highest since at least 2006. Yet the job market is strong, so basically no one has any idea what's going on. So this is percent of what's ABS? Asset-backed securities?
Yeah.
Auto-based backed security? Whatever, something like that. 60 days plus delinquent. And it's over 5%, which is in fact the highest it's been since at least 2009. Or at least 2006, he says.
Not surprising.
Could there be stress in this market without a broad read-through to the economy? And I'm going to say yes. Just 'cause think about how insane car prices were.
Do you think in the next downturn, whenever we get a recession, there's going to be like wonderful opportunities to buy like used cars and used boats from people that went way over their skis and spent too much money and just fire sale prices? I got to get rid of this stuff. Is that
Yes.
going to be a possibility?
Yes.
I think so too. I think there's a lot of people who probably overstepped their spending in recent years and are going to have to cut back and sell stuff.
All right. Jeremy Schwartz has a take.
All right. Closing my week, pondering thoughts, which he was great on Compounded Friends last week with Eric Balchunas. That's a good one too, combo there as far as ETF and market knowledge. Closing my week, pondering thoughts from an AI professor at Wharton who thinks productivity acceleration from AI will take 10-year bond yields up to 6%. Why would productivity gains take bond yields so much higher? Because growth is going to be so much higher?
I guess so. Yeah.
Isn't it kind of, don't you think the hype cycles happen so much quicker these days too, where after a while, like the hype cycles happen and like, this is what we're going to have and this is what we're going to have and then we're going to have this. And that stuff doesn't happen. It's kind of like, just kind of, drumming your fingers and like waiting for the stuff that like, I'm not saying like the AI stuff is not going to happen, but it's kind of like the hype cycle digest this stuff so fast. Like this is what's really going to happen. And then you're going to have this and the technology is going to be so great. And then you have this waiting period until it actually happens. Or for some other stuff like crypto, it actually doesn't happen. I think
everything moves faster.
We pull forward the hypes. Okay, here's another rates thing. If you would have told me this even 12 months ago, hey, inflation is down to 3% now. Inflation, it fell for 12 months in a row. Inflation is 3%. What do you think mortgage rates are going to be? There's not a single scenario where I would have said, oh, mortgage rates are 7.5%.
Right.
That would have broken my brain. It makes no sense, right? Mortgage rates are now at their highs, 7.5%. The last time the 10-year was this level, the 10-year in October 2007 was 4.5%. You know what the mortgage rate was then, 30-year?
5 6/8.
Well, it was 6.25%.
Okay.
For using your mortgage terms. But so the spreads are still so much higher today, which again, I think the Fed kind of broke the mortgage market when they bought all those mortgage-backed bonds.
Now that's a function of the Fed, right? Buying less bonds than they used to. That's why spreads are wider.
I think that's part of it. And again, the fact that you're not getting any prepayments because people aren't refinancing now. So it's. I don't think the Fed ever thought through raising rates as fast as they did what the unintended consequences would be. Now they could easily bring that spread down if they wanted to. Apparently they don't want to. But just the 7.5% mortgage rates with 3% inflation.
It's too high.
It's way too high. And yeah, I don't know how the housing market doesn't. We talked a couple months ago, like, is the correction over? Like, if this stays higher for longer, like housing prices have to fall again. They have to, right? I know people keep saying, well, it's easy to see because of the supply and demand. And that was it. Like no one, I'm sorry, eventually this has to impact the housing price market. It has to, right? Maybe nothing has to happen, but I
don't know. Well, there was an article. I mean, yeah, listen, it's hard to make the argument that it wouldn't, right? Like, I don't want to say that it's not going to impact the housing market, but there was an article in Forbes showing that like 40% of buyers get help from a family member.
I had that in
for the down payment.
38% of recent home buyers under the age of 30 used a cash gift from a family member or inheritance to afford their down payment. I talked about inheritances on Ask the Compound recently, and this is the time where if I was a young person, I'd be hitting up mom and dad and being like, listen, I don't want it when I'm 50 or 60. Help me now with a down payment.
I'm sure a lot of parents are receptive if you have the means.
Yes, they have to be. A couple interesting facts that show like if housing prices fall, there's plenty of cushion. Bank of America, 2.1% of mortgage properties have negative equity, which is lower. It's down from 25% in 2011, which is a crazy high number. Only 0.88% of home equity is being used in HELOCs currently, the lowest level since 1988. It peaked at almost 7% a few years ago. So there's plenty of room to maneuver here for people who own houses already.
Yeah. Michael McDonough made this great chart, a monthly mortgage payment using the median existing home price, assuming that you put down 20%. This was $577 at its low in 2011. In 2019 or so, I'm just eyeballing this. It looked like it eclipsed $1,000. Now it's $2,300.
He also broke down your first payment, how much goes to principal, how much goes to interest. And look at how much more goes to interest now than principal. This is why, like, if you buy a home right now in hopes of flipping it in a couple years, it's like a starter home, you're going to build zero equity if prices don't go anywhere because the majority of your money is going to interest payments now.
Right. So yeah, it's a great point. So pre-pandemic, it was like $1,000. It's $2,300 now. What?
Yeah. That is insane.
Okay. We got a ton of emails. Oh, damn it. I meant to throw some charts in here. Oh, well, we got a ton of emails. I'm not sure why this triggered such a response, but the KFC versus Taco Bell, Pizza Hut thing. KFC is massive for whatever reason. Massive. It's the largest fast food chain in China.
Yeah, it sounds like Asia has a really big KFC presence. I don't know. I guess maybe just because it's so different, right? Than most of the food they have there. That surprises me. Someone says that somehow the Colonel took over China better than Mickey D's did, which is interesting.
All right. Great quarter, guys. This is a great chart from Alpha Sense. I don't know who FTAV is. I'm sorry. Who's FTAV? Anyway, neither here nor there. The company call transcripts containing the phrase double click. This is a bubble.
Wait, what am I missing here? What does double click mean?
Let me double click on that.
Oh, geez. So if you did this for podcasts, it would be, let's unpack this a little bit.
Yeah.
That would be the podcast version of this chart.
Now, Josh actually said double click last week. I almost said something, but I didn't want to interrupt the flow.
Okay. Interesting. I'm surprised. I didn't know that was even a phrase.
I mean, oh really? Do you even conference call?
I mean, I guess I must miss. I've never used that phrase in my life. Let's double click on this. That sounds like a very AOL 1990s thing to say. No?
Well, obviously you're not going to use it in your life. I mean, you're not going to tell your wife, let's double click on this. That'd be very weird. Try it. Okay. See what happens. All right. Carl Quintanilla tweeted from Macy's. We experienced an increased rate of delinquencies. The speed at which the increase occurred for us in the broader credit card industry since our first quarter earnings call was faster than planned. We are working closely with our bank partner, Citi, whatever, to mitigate rising bad debts. Okay. If you just read that and you took them at face value, you'd say, whoa, we in trouble here? Or maybe Macy's just stinks. I think their same-store sales were down.
People are going to be blowing up their credit card scores or their credit scores.
8% year over year, something like that. So Jeff Mackey had a great thread. Macy's is hard to take seriously. Hikes shrink allowance after physical count, which raises a lot of questions. Looking for down 7% comps takes credit card delinquencies up. This is what garbage retail accounting looks like. Anyway, he has a whole thread on it. So glad that we have people like that setting the record straight on some shenanigans. You're a bad company. Don't blame macro. Don't blame micro.
Have you ever been to a department store in recent years?
Yes.
Just a depressing place. That can't believe that we ever actually had to shop like that before the internet.
The last time I was in a department store, I called you. I don't know why. I get like anxiety shopping. I'm not sure why.
It's so much easier to shop online these days. Like when I was younger, this is another like walking up the hill both ways to school kind of thing for me as a middle-aged person. Before school would start, my mom would take me to Macy's or what was called Marshall's or whatever back in the day and buy all my clothes.
Macy's was not called Marshall's. That's a separate store.
Marshall Fields.
Oh, okay.
Remember? The original was Marshall Fields.
Is that Chicago?
You would know that if you're a Midwest guy, yeah.
So now I shop on Instagram. By the way, what's this brand called? Is this Homage? There's so many ways to say it.
Yes.
Homage?
Yes. This
is where I shop.
You are up to the hills in Instagram shirts.
I am out to the hilt. Speaking of Instagram, the other day, we were talking about Alexa. Here's what I use Alexa for. Alexa, set a timer for 10 minutes. When I'm cooking the kids white mac and cheese, that's what I use it for.
That is not bad.
Or Alexa, play whatever. See, she's talking right now. I guess she's not connected to the internet. See, I don't even use it upstairs. Here's where voice, and I was talking about how Amazon burned billions of dollars on voice. Here's where voice excels. For the companies. Because
they listen in on you.
Dude, I used to think that was nonsense. Like, like 90% of the time, and I do still believe this, like 90% of the time when people think that they're being spied on, they just don't remember that like either they search for something or somebody or their spouse search for something and it's on their record. But we had like a fruit fly infestation out of nowhere. They just came hard and heavy. And I saw an ad pop up on my Instagram. And as I was telling my neighbor about it, and then I came back inside, I'm scrolling through. I'm like, what? So I asked Robin, I said, hey, did you buy any fruit fly deterrent? Did you search? She's like, no, why? So I told her. Anyway, listen, I bought it and it works. So thank you for spying on me. But nevertheless, how would you explain that?
The funny thing is I don't even get mad about it anymore. It's like, whatever. This is the price we pay.
No, I didn't. They're listening. Okay.
Yeah.
Maybe they hear some embarrassing things, but thank you for serving up that fruit fly thing.
All right. What's the other Bank of America?
Or I guess an alternate explanation that is probably more reasonable is other people in my neighborhood are experiencing the same thing and are buying fruit fly stuff. So they served it up like on a local thing.
Maybe Alexa detected the fruit flies in your house for you. You didn't use your electric zapper on them? Your bug zapper?
Oh, I've been zapping to high smithereens, but there's too many.
The noise is so, yeah, it's a great
love
noise.
It. All right, let's get rid of this. What's this? This credit card thing.
Okay. I got a credit card thing in the mail from Citi the other day. It's like Citi Simplicity Card. 0% intro APR for 18 months, 21% after that, but 18 months on balance transfers to or purchases from me. How are these credit cards able to still roll out 0% credit cards? I look, there's no other. So my finance brain says, why wouldn't I put every single one of my purchases on this credit card and just put all the cash into 5 or 6% T-bills for 18 months? And that's way higher than I could get from a credit card reward.
I feel like there's got to be some fine print in here that you missed.
18 months, 0% intro. I mean, I don't know what maybe they would give you a low limit on it or something, but
there's
that seems like.
Oh yeah. You know, that's probably what it is. Yeah, you probably have $1,000 limit.
And I mean, there's no other rewards you get with it, but that like in a high rate environment, that 0% credit card, like if you're thinking about doing a renovation or something, why wouldn't you use this kind of thing for a while at least before tapping into your home equity or whatever you're thinking, right?
Well, because I'm saying the cap is probably $1,000.
Okay, that maybe it has to be it. That's the only thing I can think of.
Ben, I saw a chart from Fidelity.
Whoa! You can't post demographic charts. Sorry.
Well, I wanted to serve this up to be a good co-host and see if you had any thoughts.
Okay.
The percentage of population older than 55. It's 27% in the United States, 30% in Canada, 36% in Germany, 39% in Japan.
A lot of people keep talking about this like it's going to be the end of the world, economically speaking, and these places are in trouble. My default is we'll figure it out.
Well, guess what? What about when 60 is the new 40?
That's true. People are living longer. I think that, and obviously the baby boomer population is a big part of it. But
I don't put a lot of credence in here, as you know. All right, we got an email from a listener in response to Ben's post about like not needing as much as you might think in retirement.
Basically, people who have a lot of money don't end up spending it all. They rarely do or come close to it.
So I did a follow-up piece on this, but the big takeaway that was pretty eye-opening is like, listen, I'm almost 60 years old. Everything that I wanted to do with money for the most part, I've done. Been there, done that. I took trips. I had a nice car. I bought a nice watch, whatever. That stuff doesn't move the emotional needle at 60 the same way it does when you're, say, 40. And so I think people severely underestimate that. Now it's a balancing act. But I think in large part, this is why people just don't spend the way that they do when they're 70, 80. I mean, I know I don't know. It sounds obvious to me, but maybe it's not obvious.
Your conclusion of, so spend some more when you're young and you can enjoy it or want to enjoy it. Because I agree, when you get to that age and you're kind of set in your ways, there's certain things you just don't want to spend money on anymore. And I actually heard from one frugal millionaire one time who told me like he built a huge nest egg and he couldn't spend it and he didn't want to and he's giving some away, but he said, I gave myself certain rules. Like if I'm traveling, I'm always going to pay for first class. He's like, I cut back on so many other things, but if I'm traveling, so I think find little conveniences like that to treat yourself on, I think helps. But there was another one who said, this guy he emailed us. He said he has a $4 million net worth. He says, I see so many things about how much money you'll need in retirement. I have no idea how to answer the question. I don't expect to. So we keep saving and saving because digesting what life will be like without kids' expenses, limited to no mortgage and lots of free time. I just want and need more. If that results in my kids inheriting a lot of money, so be it. I just think the retirement discussion has so many variables people don't like to admit they don't have a clue about. And that's where a lot of the concern around money comes from. So I think part of it is just there's so many unknowns out there and people just want the safety net. And they
listen,
can't
I get
get
that's
rid
a
of the
personality
safety net.
thing. I totally get that. But like once you get to a certain age, you're like, I'm not going to spend that much money. I'd rather just, leave it to my grandkids.
True. And that's fine if you want to give it away to charity or give it to your grandkids or whatever. But I think you should also enjoy yourself a little. I think it's okay if you've spent your whole life working and slaving away and saving money over time, find little ways to treat yourself that
I also think
the rules.
Don't you think that at least speaking for myself, I am at the age where I think this is peak money enjoyment for me.
Yes.
Where I'm able to do things with money that I wasn't when I was younger, that at some point will not be special because that's how human beings work, right? The things that were once a luxury become normal or just the excitement wears off. So I think I'm peaking right now, and hopefully my peak lasts many years. But I know it won't always be this way.
That's also why I've been okay to pull forward some expenses that with my kids now, so I can enjoy this stuff with them now. Because I know in the future they're going to be too busy or not want to hang out with me and my wife.
And you're gonna be older and grumpier.
Older, yeah. So I'm okay pulling forward some of those expenses and not thinking through if I would have just saved this money, what would it be worth in 30 years? That's why being a parent has led me to pull forward a lot of that stuff.
All right.
One more feedback thing. We got a lot of feedback
ahead.
on dishwashers too. Regarding dishwashers,
oh, that's a great email.
Do work without rinsing, but you can't use pods. I highly encourage watching this video. The host breaks down a dishwasher, explains how it works. TLDR, dishwashers have a pre-wash mode before the wash, and when using a pod, there isn't soap for the pre-wash. You need soap in the main location.
Lost mate. There's a wash before the wash?
Pre-wash. So you need the dish detergent. He says use powdered detergent, and the dishwasher works amazingly well. So those pods maybe it makes your life easier, but they don't work as good.
So it drives me nuts when Robin will put something with sauce in the sink, and she refuses to rinse. No matter how many times I say, just please rinse. Because in the morning, I'm scraping it off,
But do you ever get the pods leave half the pods still in the thing when it's done?
I have a pretty high hit rate. But I think I'm willing to go the extra mile and do this pre-rinse or whatever because it's annoying. I'd rather, listen, if I don't have to rinse dishes, fantastic.
But in the past, you would pour the powder in, and now it's the pods. So maybe you got to go back to the pour stuff.
Yeah. I'll try it out. All right, recommendations. Ben, what do you got?
All right, we watched The Whale on Paramount Plus because there's just nothing else to watch right now. And I think we're going to be in a bear market for content for a while.
But there's everything to watch. Didn't we just talk about this?
Yes, but I'm saying new stuff.
Have you ever? All right, go ahead.
So we watched The Whale with Brendan Fraser, and this is a Darren Aronofsky movie, and this is a film and not a movie. This is the kind of movie they make because they want someone to get an Oscar. And his performance was great, but I didn't say anything the whole movie. And my wife at the end goes, "I know you didn't like it," and I said, because I think she liked it more than me. And I said, why do you say that? She said, "You don't like sad movies," and this was a sad movie. And it's the kind of movie that is depressing, and it gets more depressing, and another sad thing happens, and it's kind of come, seriously?
I love sad movies.
Really?
Yeah, I'm a big emotion guy, and I like this movie a lot.
You liked The Whale?
I did.
When did you watch it?
On an airplane.
Okay. I can't wrap my head around it. It was a well done movie. Not for me.
Okay.
I'm surprised. I was gonna say you should not watch this.
No, I liked it.
Okay. Your movie taste is just it's like a roll of the dice for me. I can never tell something you're gonna like.
You know what I spent the last week watching? And 4 times Robin's like, are you really doing this? I went down the garbage fish rabbit hole. I was talking about, they were talking about the podcast. So I watched I didn't watch Open Water or 47 Meters, but I watched 47 Meters, the Uncaged by accident. This is a sequel. I thought I was watching the original. I watched the sequel. I watched The Reef. I watched the one with Blake Lively.
Blake Lively one's not bad.
What was that called? The Reef. They're all blended together. That was a good one.
Okay, I've never heard of any of these movies, but
The Shallows.
Okay, yeah, that was it.
Yeah.
I can't believe you liked The Whale.
I did like The Whale. Although I feel like I don't love Darren Aronofsky movies. What else did he do? He did
the Black Swan one.
Yeah, I liked that one. Film. See, it says films. Yeah, he's a film guy. The Wrestler. Great movie. Requiem for a Dream. Mother, I did not watch. I have no interest in that. I didn't like Pie. How about that?
Actually, never saw that one. All right. What do you got?
I watched 2 things on top of all the fish movies. The Johnny Manziel doc was pretty good. I mean, it was quick, and he had a quote there that I believe very strongly is true. He said, when I got everything that I wanted, it was the most empty I felt inside. And I know people refuse to believe this, but this seems to be like a common thing. If you are very driven for money, fame, whatever your purpose is that you're obsessed with, once you get it, like the chase is the fun part.
Yeah.
And then once you get what you want, and it's not everything that you expected. It's like a massive psychological blow.
I know you're not a big college sports guy, but he was an amazing college quarterback, and I'm not surprised he was a bust in the NFL.
I don't know why I watched this one, but I watched the Johnny Depp Amber Heard doc.
What's that on?
Netflix.
Okay.
I was saying this to Josh. You know what's incredible about Netflix? The shows that are top 10, they just pop up. It's not like you don't see advertisements. They're just
there's no marketing.
The advertising is on the platform itself. That's it. Yeah. It's genius. They advertise on the platform, and it works. So I watched it.
They should probably add more top 10 lists. Like they have the top 10 movies and TV shows. I bet if they added more top 10 lists, it would drive more. If they could drive more stuff if they wanted, I feel like.
So the biggest takeaway for me from watching that is just how vile social media is. And there's a strong opinion. Basically, everyone took Johnny Depp's side because he's famous, I guess, and other factors.
Which is kind of surprising because he's not a great guy by all accounts.
No, she did, and there were parts where she admittedly did not come across well, but it was so one-sided, so one-sided, and the social media, like just people spending their entire lives following this and making money off it was just like really gross to watch and not great.
You remember in my Don't Fall For It, I wrote about Hunter S. Thompson and Johnny Depp and how Johnny Depp blew through all his money and he was spending $3 million a month on wine.
Wild.
Pretty good.
Wild.
Not bad.
Guy likes to party. Okay.
See, he would drive the Acura NSX.
animalspiritspod@gmail.com. We'll see you next time.